All right. Yeah, something about being really boring. This is talk on economics. How do you make that exciting? I don't know. But I will tell you right now that the business philosophy on my ranch kind of goes like this. The production practices that I use, right, whether I'm, say bale grazing or swath grazing or feeding cattle, those are the least important parts of my business. Right? Which production practices I use doesn't really matter as much. It's determined by the economics and the finance. Right? Is it going to pay? Because every year it's going to be different. Right? The market values of the price of hay or the price of the swath grazing I buy might change. So I've got to make a decision every year on what production practices to use. So the economics and finances are two different sets of numbers. My economics is it profitable, right? And I do that by a gross margin analysis. The finance side of my business is, can I cash flow it, right? Those are two different sets of books, and we have to understand the difference between them. A banker will give you a loan for something that you can finance, and it could be economically unsound, right? You could be losing money at it, but as long as you can finance it, they're okay with it. So it's our job to understand that there's a difference between those and make sure that we know that. So let's look at an example. Quite a few years ago, long time ago, I had a little small herd of goats. And so I'd show a few pictures of baby goats on my presentation. So baby goats are pretty cute, right? So all of a sudden I got known as the goat guy. I have no idea, I didn't know much about goats, but all of a sudden, oh, Steve, you're the goat guy. I know you're the goat guy. And a little while after, I had a fellow show up at a conference and said, Steve, I want to partner with you. I want to buy 1,000 goats. I'm like, oh, it's a big step up from 12 because I'm the goat guy. And at the time, British Columbia, province of British Columbia was going through an environmental stage, and they didn't want to use chemicals anymore. So they were hiring people to graze goats on all the cut lines and the power lines that go across the mountains, all those cut lines. They had to keep the shrubs down. And they were hiring people and paying them $1.25 per goat per day to graze. Right? You didn't have to rent land, right? They were paying you to go do it. I'm like, hey, that seems like a pretty good deal. So I ran the economics on it, did a gross margin, and we were going to be very profitable. This is great. And then I ran my finances on it. And we could actually get a loan, buy 1,000 goats, and have them paid for within 1 year. Right? So I could easily finance that. A bank would give me a loan for that. Awesome. Both of them are working. My economics is working and my finances is working. Anybody want to guess why we didn't do it? Why we didn't go ahead and do this? Because they're goats. Actually, there's one thing that has veto power over economics and finances, and that's human resources. Okay, at the time in Alberta, we were going through the economic boom, right? Oil field was going crazy. You couldn't hire someone for under $65 an hour. It was really hard to find people to work. I went into the town to get supplies, and I stopped at the local KFC for lunch, and there's a sign on the door that says closed due to labor shortage. Like, what? Like, how does that happen? How come I can't have lunch? So if I would have put an ad in the paper for 3 goat herders, how many would I get? And if I did, what quality would they be, right? We're not going to be able to hire people to do this job, to go up into northern BC and chase goats around for the summer, right? And when they quit, I don't want to go up there. I've got my own business, my own family at home. I'm not going to be chasing goats around for the summer. So we didn't do it, right? So the point of this is that the production practice that we use, we figure that out with economics and finances. But human resources has veto power over top of that, right? We can still make decisions why I wouldn't do something for that. So that's my basic business philosophy. We got to pass those certain tests to be able to do something. But my point is economics and finances is more important than what production practice I use. Okay, so we have to run that through. Anything that I talked about yesterday, to me, doesn't really matter the production practice unless it's going to make me a profit, right? There's no sense in me moving ahead if it's not making me a profit. So, okay. Has anybody ever seen this graph before? So this is a research study done by Darren Qualman in Canada. And I'm going to say that the numbers are similar to the US. This was 92 years worth of net farm income in Canada. Okay, the top of the blue line here is the total net farm income across Canada for all farmers. The top of the green line is the farmer's share. Anybody see a problem with this? Right? Since about 1985, the farmer's been getting almost nothing. If you read Darren Qualman's report, he breaks it down. He says from 1985 to 2007, the farmer took home 0% of the profit. Absolutely nothing he took home. Okay? If you extrapolate that out to 1985 to 2016 when they ended this, the farmer took home 2%. Anybody okay with that? Right? We have to change this. This is not right. I'm okay with this. We need ag business. I need to buy supplies. I need to buy products. We need them. I'm not criticizing them. I'm perfectly fine with this. But over here, that's not right. Okay, we need to change that. So the little blips here, I'll just explain the little blips here. This little red part is we lost money. We actually survived on off-farm income, burning up inheritance, selling assets, selling land. And that happened in 2002 when most of Canada had a severe drought and the beef industry had to destock drastically. And then in 2003, we hit the BSE when all of a sudden it just crashed. So the beef farmers really took a hit here. Okay? In 2007, there was a big change. That's when the US opened up the ethanol industry. And the grain farmers got a boost, right? You take 40% of the US corn out of the market, all of a sudden the wheat and the barley and everything kicked in for Canada as well. So we got this big boost here. That was in the grain side, not necessarily in the cattle side. But who got the really big boost? Ag business got it. So do you know whose fault this is? Do you know who caused this? The farmer. Right? The farmer chooses to spend all this money. Right? Nobody's forcing you. So in the US, this is a similar graph. Okay? No one's forcing you to pay for all that stuff. Right? But we're marketed to, we're sold to, we get all sorts of experts telling us that this is what we need to do. We can choose not to do this. Okay? So this is actually a passion of mine. I want to fix this graph. And I'd love to have Darren Qualman actually extend this out and see where we're sitting now, because it's an older study. But my passion is to fix this. Let's get it back up to 50-50. That's my goal. So that's what our talk's about today is economics and understanding how to fix this and understanding our own businesses. So I need things really simple. I'm a very simple guy, and I need to, when I learn something, it's got to be very basic. So I'm going to show you very simple here. It's a big number minus a little number. Okay, to make a profit at something, we need a big number. Oops. Right, our gross margin minus our costs gives us a margin. Okay, if our gross product goes up, but our costs go up at the same amount, right? Like, let's say we are creep feeding our calves, right? We get bigger calves, but it costs us quite a bit to do that. If the margin doesn't change, we're no farther ahead. So we're wasting our time. Okay? Or if we are the low-cost producer, right? Let's say we swath graze in the winter and we get our costs really low, but our weaning weights are hindered because of it, right? If the margin doesn't change, all three of these scenarios, we're in the same boat. I don't care if you have a higher gross revenue, right? You can brag all you want about how your calves are heavier, or you got X number of dollars for your crop you sold. If your costs go up and your margin doesn't change, it doesn't matter, right? Are you a low-cost producer or are you the high-producing producer? I don't know either one of those that are making profit. What I need is to extend my margin. So my focus is getting that margin wider. Okay. Excuse me. There's only 3 ways to make more profit. So if we've got the big number and the little number, we can focus on trying to make the big number bigger without adding costs. How do we do that? Depending on your profit center. Or we can make the small number smaller. Okay, we can work on being that low-cost producer. And the whole idea, though, is to get that margin to be bigger, not the gross revenue, not not lower the cost. We've got to get that margin bigger. The third way is to increase turnover. If we've got our big number as big as we can get it, and we've got our small number as small as we can get it, we can do more of it. The biggest problem in agriculture is we don't understand this. We don't go through this process and figure out what our margin is. But we're broke, right? We're not making enough money, so we decide to do more of it, right? We're going to increase turnover. The problem with that is if you've got a negative margin and you don't realize it, if you do more of it, what do? You lose money faster, right? Not the target you're after. So we have to make sure that these two are proper first, and then we increase turnover. Okay, there's so many producers that say, oh, if we just get a loan and buy more cows. Okay, that doesn't always necessarily fix your issue. You have to make sure your margin is good first. So that's where we focus on a gross margin analysis. Okay, this is what normally happens in agriculture, right? You guys understand this graph? Yeah, most farmers get this one better. We don't want to have the negative margin, but that's what happens in most situations, right? We've got this negative margin. The most successful businesses, there's one type of business that's more successful than any other type, and it's a franchise. Okay, McDonald's, A&W, these are franchises. The reason they're more successful is because somebody's already done the numbers, someone's figured out the math, and then they sell it to you, right? It's a recipe. So someone can take on an A&W, and they already know how to, you're taught how to run it to make a profit. So those are businesses that are 95% successful. They're franchises. I call it it's a repeatable business. You can do it over and over, and it'll be successful. Most small businesses fail within 10 years, right? Like 90% of small businesses fail within 10 years because they don't understand the numbers. They haven't figured it out. They're trying to do it on their own. Nobody's given them a recipe. And farm businesses are no different, right? We're small businesses. We don't have the numbers figured out. Nobody's sold us the recipe. So most small businesses would fail on the farm basis, except we subsidize it, right? The only reason we don't fail at a rate of 80% is because we subsidize those businesses. There's multiple ways that we subsidize the farm. Okay, we can do government subsidies, right? We get a little extra money here, a little extra money there. We've got crop insurance. We've got farm fuel. You guys got farm fuel here, right? A little cheaper. Farm insurance, right? That's a subsidy. You might get a little bit extra money to be putting up fencing around your riparian area, right? There's always these government grants that help. So that gives us a little bit of a boost on our gross revenue. We get this extra money. Another way is unpaid labor, right? We don't actually pay ourselves. The number of farmers I know that don't account for their labor in their business, that's a subsidy, right? We need to be able to account for what we're doing. What is your opportunity cost for your labor? What could you make at another business or at your off-farm job? Okay, that's what you should be paying yourself. We need to account for our labor. Off-farm income. Okay, having that extra job that's pushing money into the farm, that's a subsidy. Okay, you don't hear of someone having an off A&W job, right? The owner of A&W doesn't have another job to subsidize his A&W business. Okay, but we always hear about off-farm jobs on the farm. Now, when I was young, I had a job. I used to drive a truck and run my farm. And when I got into at the time it wasn't called regenerative agriculture, but when I got into the regenerative agriculture field, I had people criticize me that, oh, well, obviously what you're doing is not working because you have an off-farm job. And I was like, oh, right, kind of feeling guilty about my off-farm job. But once I got into understanding the economics on it, I'm not opposed to anybody having an off-farm job. I don't think that was right that they would criticize me back then because I had a very small business, right? My farm business was very small. If your business can only pay you part of your salary, right, what you need to live. Let's say your household needs $50,000 to survive, right, to pay all your bills and your mortgage and fuel and food on the table. Let's say your household needs $50,000. If your farm is only big enough to pay you $30,000 and somebody from the farm has to work off to make up the other $20,000, okay, there's nothing wrong with that. Maybe you've got a multi-generational farm, then you've got 2 or 3 households that need to earn an income. If you can't make up enough to pay 2 or 3 incomes for that family farm, somebody or more than one person might have to work off to make up the balance. Okay, there's nothing wrong with that. What I have an issue with the off-farm job is if you need your off-farm job, you need $50,000 to survive, but your off-farm job pays you $70,000 because you have to input $20,000 into the farm every year. Okay, that's where I have an issue with it. We don't want to be subsidizing our farm with the off-farm job. Now, to get started, you might have to, right? If you're trying to build up a farm and get it started, you might have to, it takes money to make money. But if that's in your long-term plan, is to rely on that $20,000 going into your farm every year, that's not a repeatable business, right? That is not something that's, somebody would want to franchise. So we've got to make sure that our farms are repeatable, okay? So we don't want to rely on that off-farm income. Land appreciation, okay, that's a big one. Since, the last generation, most of them have survived because of land appreciation, right? They bought the land for $25,000 50 years ago, and now they can retire because it's worth $350,000, right? If it wasn't for that, would they be able to retire, or would they be working forever? In most cases, that's their profit was the land. We've heard the term being dirt poor and land rich. Okay, that's what that last generation did. This generation cannot farm the same way the last generation did, because they relied mostly on land appreciation. Now we might not be able to rely on that, right? It might go up some, but we might end up having a crash as well. So, and the real estate value is too high for agriculture to pay for it. So we've got to understand that we can't rely on that right now. And the last one would be inheritance, right? You inherit a piece of land, so you don't have land rent, or you don't have any land payments for it. So that's not in our economic calculation. The reason I say that I need a farm business to be repeatable, right? The way to understand that is if this generation, let's look at mom and pop. Okay, they've owned the farm, they've built it, they've paid for it with these. Okay, they worked hard. I'm not criticizing unpaid labor, but they worked hard at it. They sacrificed and they paid off the farm. They own the land, they own the equipment, they own the cattle. Okay, they can go out and buy a new pickup. They have the cash flow for it, right? The difference between economics and finances. They can take a holiday every year. But when they want to sell that farm to the next generation, right? The offspring want to take over the farm. Can they farm the exact same way, but have a payment on everything? Okay, now there's a payment on the land, there's a payment on the equipment, and there's a payment on the livestock. Right? All that extra money that mom and dad had to pay for the vacation now goes into payments, right? And the next generation is forced right now to do more of this, off-farm income, because they have to make all those payments. So the best gift that the previous generation can give to the new generation is to make sure that their farm is repeatable, right? Basically, you set up your economic calculation that you can not have any of these and to make a full payment on all the assets that the farm owns. If they can do that and still have a profitable business, then it's repeatable, right? Then you could do it again. If you could buy another farm somewhere else, hire someone to manage it, and run it the same way, and it makes a profit, not only does it pay the manager and the employees their wages, but makes a profit, then it's a repeatable business. So we have to make sure that our farms are repeatable, right? We're not subsidizing them with these things. See, we think we're making a profit because we have all these extra things. But we need to make sure that we can do that without having those subsidies. I'm not saying don't apply for the government subsidies. That's your choice. But to understand your economics before that, to make sure you're profitable, is one of the most important parts of my business. And I'll tell you right now, understanding a gross margin analysis was one of the breakthroughs on my business. Right? One of the most important things I learned was in 2001, I took the Ranching for Profit school. and I learned how to do a gross margin analysis. Since then, I've taken 2 or 3 other schools that also do a gross margin. So there's lots of places you can learn it, but I didn't learn it in college. That's not where I learned this. It was in private industry. Okay, so we've got to work on that margin. So what do we need? How do we figure this out? After we pay ourselves labor, right? Number one, when I was growing up, when my dad was farming, even neighbors around us would absolutely refuse to pay themselves labor, right? When I remember going over to a neighbor to get some grain ground up for my cattle to make some chop. They ran it through a hammer mill. And I was telling my neighbor that, it's cheaper for me to come over here, and even including my time and labor, right, driving the truck over to get grain from him, I was getting a better price than I could from the feed mill. And he scoffed at me. You can't charge yourself labor? What are you talking about? Right? I'm like, oh, I guess I'm not supposed to charge myself labor. That's one of those other paradigms that I had to get around, because my neighbors, my dad, everybody said you can't charge yourself labor on a farm. Right? That's ridiculous. And that was just the mindset. So we have to change that. So after labor, we have to cover 3 things. Number one is opportunity cost. So opportunity cost is, sometimes it's hard for people to get their head wrapped around it. But there's an opportunity cost on everything that you own. Let's call it a measure of your management, how well you're managing your assets. So the best way to explain it, I guess, would be, let's say you have a piece of land that you got through a bank, right? You've got a mortgage on that piece of land. I'm going to use easy numbers here. Let's say it's $100,000. You own this $100,000. The bank actually owns 50% of that. You're still making payments on $50,000. You've paid off $50,000, right? So half of it is yours and half of it is the bank's. You're paying interest on the half that the bank owns, but there's no interest being paid on that $50,000 that you own free and clear, okay? But the opportunity cost is you could sell that $50,000, sell the land, get that $50,000, and pay off another loan. Right? Maybe your other loan is 6%, right, on your tractor. But if you were to sell that, you could take that $50,000, pay off another loan, and save yourself 6%. Okay, so there's an opportunity cost on everything that you own. So in my economic calculation, I actually ignore all my loans, all the payments I have, and all the interest rate. That's in finances. In my economic calculation, I put an opportunity cost on everything. So I put a 6% opportunity cost on the total value of that land. So now I'm paying 6% on all of it, not just half of it. Okay, in my books. That way I can value that is, what's the measure of my management of those assets? Because I could save 6% by selling it. So I'm paying 6% on half of it, and I could be saving 6% on another. Now 6% is a random number. The easiest way to figure out what your opportunity cost on your farm would be is what's the highest loan that you're paying right now? Is it 6%? Is it 7%? Is it 3%? That would be your opportunity cost. Now I like to aim a little bit higher. On my farm, whenever I'm doing my economics, I always set my opportunity cost at 10%. One, it's easy calculation. I like easy math. And also, I'm setting the bar a little bit higher, right? So I like the mistake when I end up with more money in my pocket when I'm wrong. I like those mistakes better. So we have to cover opportunity costs. Now, it never shows up in your finances, right? That number never shows up in your bank account, but it is a real number, right? Don't kid yourself, it's a real number. The other one is depreciation. We have to cover the depreciation of all those assets. Now, there is some assets in some situations that appreciate, but that's rare. And land is one of them. A lot of times those are appreciating all the time. But most equipment that we have are depreciating. Most livestock that we have depreciate over time. So the actual calculation for depreciation is your purchase value minus your salvage value divided by the number of years that you own it. Okay, so let's use some easy numbers here. Let's say we bought a tractor for $30,000. We owned it for 10 years, and then we sold it for $10,000. Okay, so purchase value was $30,000, salvage value was $10,000, and we had it for 10 years, so that's $20,000 in depreciation divided by 10 is $2,000 per year, in depreciation. Okay. Now, to properly account for that in your economics, we need to make sure we can cover that loss, because that's money off our balance sheet every year. So if we wanted to cover that, let's say we took $2,000 per year out of the revenue that the tractor is making, right? So whatever profit centers it's working on, it has to have some of that revenue. It's got to pay for itself. So we put $2,000 into a bank account every year. After 10 years, we've got $20,000 in the depreciation account. Okay, so we sell the tractor for $10,000. We've got $20,000 in the depreciation account. Now we've got $30,000. We can go out and buy a new tractor. Okay, plus or minus, right? Prices go up and down. But on paper, that's what we have to do. Livestock is the same way. Okay, I'm going to use easy numbers. I know this isn't what livestock are worth right now, but I like using easy math. Let's say a cow is worth $1,000. Okay, the average cow stays in your herd for about 5 years, plus or minus, right? You've got some that are 14 years old, but a lot of those bred heifers go out. So if your average animal goes out in 5 years, if she's worth $1,000 to buy her to begin with, and her cull value is $500, okay, so we have a loss of a depreciation of $500 on that animal. If she was in there for 5 years, that's $100 per year. Okay, so can you afford to take $100 out of the sale of every calf every year and put it in the depreciation account? Okay, so at the end of 5 years, we take our salvage value of $500. We take the $100 times 5 years, is $500, and we can go and replace the cow. Okay, that's accounting for depreciation in a livestock. It's the same as with equipment. We need to be able to cover that. So that $100 has to be accounted for every time you sell that calf in your economics to make sure that we can cover our depreciation. Okay, and last is inflation. Okay, I know our government or our banks are trying to keep inflation, between 2 and 3%, right? So every year, price of milk is going to be more expensive in 10 years than it is today, right? We know that inflation is going to happen, so we have to account for that as well. So after we pay labor, I have to cover an opportunity cost of maybe 5 to 10%. I have to cover my depreciation of anywhere from 5 to 50%. Right? Some equipment depreciates a lot faster. So let's say it's 10%, just to argue. So we got maybe a 5 or 10% opportunity cost, 5 or 10% depreciation, and inflation of 3%. Okay, so that could be up to 23% we need to cover after we've paid our labor to be a profitable business. How many farms are getting 23% return on assets? A banker really likes your numbers if you can get 5%. Okay, but to be profitable, we need to do better than that. Right? A bank will finance you for something that you're not making any money at. Okay, we need to do better than 5%. Actually, the average farm right now in North America is doing about 2%. Okay, so we need to fix that graph. We need to take more of that money home, not pay so much to ag business. Okay, so how do we do that? This is a little schematic that I'm going to draw. It might get a little bit complex to begin with, but I think it'll make sense to begin with. Like I said, I want to simplify things. I need it simple to understand it, so I'm going to simplify it here. To make a profit, we need to take a big number, and we need to subtract a small number from it. Okay, in this case, our contribution margin minus our business overheads. If this is a big number, and this is a small number, we make a profit. Pretty simple, right? Pretty basic. Okay, now the contribution margin is made up of your gross margin minus your profit center overheads. Same thing. We need this to be a big number and this to be a small number in order to make this positive. Okay. The gross margin is made, the gross margin is made of your gross product. You can't quite see the bottom there. That's gross product minus your direct costs. This needs to be a big number. This needs to be a small number. If anywhere through this, the big number and this little number are wrong, or backwards, we know where to fix it. Okay, that's the key to this. We're breaking it down. When your accountant sends you your numbers back, everything's grouped together and you can't tell. So, but if we structure our numbers to to break this down in this order, we can see where the problem is. Is it our direct cost that's the problem? Is it our gross product that's the problem? Is it our profit center overheads? Is it our business overheads? Okay. So there's 3 different sets of costs here. Okay, let me break that down. Our direct costs are anything that is usually on a per head per day basis or a per unit basis, maybe a per acre basis, and they get used up. Okay, if you put, the feed you put into your animal, the hay you buy, okay, it's a per head per day per unit basis. So, if you got 1 more cow, you need that much more pounds of feed for the winter. Okay, or on a per acre basis, right? Every acre you have, you need that much more seed to put it into the ground. And both of them get used up, right? When you're done, they're gone. Okay, so those are direct costs. They're on a per unit basis and they get used up. Your overhead costs, so we've got profit center overheads and business overheads, those don't get used up, right? They're always there. But the difference between them is that this one is only used for the specific profit center that we're talking about, and these ones are used for the overall business. Okay, an example of that would be a combine. Okay, it's only used in the grain profit center, right? There's no sense in penalizing the cows for owning a combine. Whereas your pickup truck, it gets used in all the profit centers, right? It goes to town, it can go out and check the cows, and it can go help with the grain operation, it can help with the goats and the silage and the hay. So that overhead would go into the business overheads. A way to figure out if it should go in the profit center overheads or business overheads is if you were to get rid of that profit center, would you be able to get rid of that piece of equipment or get rid of that labor? Then you would know if it would go in the business or in the profit center overheads. I've got to apologize, I didn't explain what profit centers are. Some people call them enterprises, so it's a part of your business. So everything here in blue would be one profit center. So you could have a cow-calf profit center. You could have a feeder profit center. You could have a goat profit center. You could have a pasture chicken profit center, a silage profit center, the grain profit center, the grazing profit center. Okay, what we're doing is breaking the farm down into little segments to be able to figure out which profit centers are making money. I remember the one phrase from the Ranching for Profit school, the easiest way to make more money on the farm is to stop doing things. Okay, I'm like, what? That doesn't make any sense. But if you had 5 profit centers on your farm, 3 of them are making money and 2 of them are losing money. If you stop doing the 2 that are losing money, instantly you would make more money on the farm, right? Because you would stop losing. So the easiest way is to either fix the profit center or to get rid of it. And then you would make more money on the farm. So that's why we're breaking this down into individual profit centers. Now, so everything in blue is one profit center, okay? The business overheads and the profit center overheads account for assets, operations, and some labor, okay? Now, everything in blue here, that's one profit center. We might have multiple profit centers. So underneath every one of these, we'd also have this little tree. Okay, how many profit centers do you have, right? Do you have 3, 4, 10, 20, right? There's some farms with a lot of different profit centers. So this does get complicated, right? It can get quite drawn out, a lot of paperwork. But it's as simple as the big number minus the little number. We just do it over and over and over. And the reason we do this is to help make decisions easier. If you've got the numbers saying that, my direct costs are fine, my gross margin's okay, but maybe it's my profit center overheads that are too high, right? In another profit center, it might be, my profit center overheads are okay, but my direct costs are too high. Okay, we can pinpoint where the problem is once we go through this, and it's really easy to make decisions. You get your numbers back from your accountant, and you see the overall farm is losing money. How do you fix it? Right? You don't know. So you have to break this down. It takes a little bit of work, but boy, it's worth it in the long run. Okay, so each one of these would have this tree underneath it. So I just extrapolated it out there a little bit. But, so we take depreciation and opportunity cost off those 2 spots. So our business overheads and our profit center overheads. So throughout the paperwork, we would show where the depreciation and opportunity cost comes off. I basically break this down into 2 pages. We're not really going to look at it today, but this would be at page 1. We do our gross margin calculation, and then we do page 2, which is our contribution margin calculation. Okay, so then we take the answer from page 1 and fit it into page 2. Okay, so 5 minutes? Okay. So if anybody's interested, I can send you the paperwork, or it's actually a computer file, it's an Excel spreadsheet, that will do both these, page 1 and page 2 together. You just have to email me. So I'm sure you can find that on the internet. I gladly send that out to you. Okay. So to make this work, though, I have to understand, have some targets. And I've got these ratios that I work on. So my gross margin ratio is my gross margin divided by my gross product. Okay. I like over 25%. I love over 50%. So to show what this means, 50% your gross product or gross margin right here divided by my gross product. Okay, that's my ratio that I'm looking at. If I was to have $100 in gross product, right? Let's say for every $100 I make, I would like $50 in direct costs, which gives me $50 in margin to go forward in my calculation, right? So that's what it is. A gross margin ratio, if I want it above 50%, I want $50 in costs. So for every $100 I make, $50 in cost. I've also got a contribution margin ratio. Okay, it's one step further, that page 2 that I was talking about. I just take that a little further. From that $100, $50 in direct costs, I want $10 in profit center overheads, which gives me $40 to move forward. Okay, so my contribution margin, I would like to see over 40%. Okay, if you pull that out further, I would want 20% in profit. So of that $100, I'd want $20 in business overheads, which leaves me $20 in profit. Okay, so if I'm working out my numbers just on this part, that's why I'm targeting $40 here, or a 40% gross margin ratio. Okay. I also have a rent ratio from grazing. It doesn't necessarily work in every environment, but I'd like to see my rent under 30%. Just another ratio that I work on. Now, those are just numbers that I use on my ranch. You'd have to make up your own benchmarks, but those are my targets. And I like to aim up here, so those are pretty tough. My custom grazing operation, I can make that. Right? If the cow-calf profit center, pretty tough to make that. My pigs, I'm about, I'm at 25% or less. So depending on your situation, your profit center. But if you're only selling, 100 items in a season, you need a pretty good margin to be able to make a living at it, right? If you're only selling 100 calves, you need a good margin. If you're Costco and you're selling 500,000 eggs a month, you don't need a very big margin, like per egg. Okay, so that margin can be a lot smaller if you're on a very large scale. So depending on where your farm sits, if you're selling 100 chickens, right, you need a good margin on it. If you're selling 100,000 chickens, you don't need as good a margin to make a profit. Right? So where are you sitting on that scale? So that's why my 50% is pretty aggressive. I'm selling 1,400 custom grazing animals in a season. So I need a decent margin on it to make a living at it. Okay. So my goal, by understanding that, is to fix this. Okay. So I'm going to shut her down there. We got a few minutes left for questions. I know that was really boring. What did we call it? Really boring topic. But I'll tell you right now, one of the breakthroughs on my business was understanding this. Right? I don't care how boring it is. It's very important. So any questions?
How would you figure going into like hyperinflation?
Hyperinflation. Explain that a little bit better.
Like where the inflation's at a higher rate than 2 to 3%. I mean, you're looking at more like 10, maybe 15%.
Okay. It's your situation, your environment. What do you think is fair? Okay, I just picked 2 to 3% because that's what the history's been in, the last little bit. If you think that it's going to go higher, bump it up, right? You're projecting, you're guessing what's going to happen in the future. Interest rates could go higher, right? So is my opportunity cost going to be 6%, or should I put it at 12% or 18%? Okay, these are your numbers. You put in the numbers that you think are accurate. When I do a gross margin analysis, I don't do it for the bank. I don't do it for income tax. I'm doing it for me. So if you lie to yourself, you're just lying to yourself. right? So what do you think is fair in your operation, in your situation? You put in the numbers you feel. But we have to account for those. Most farmers are not accounting for depreciation. They're not accounting for inflation. They're not accounting for opportunity cost. A little bit of an example, years ago I had a friend that was doing the same thing I was doing. He was a custom operator. We were doing custom animals for the winter, and this one year we both did a swath grazing for the winter. He did his numbers based on labor, right? He was looking at a profit that just paid his labor. I did the same understanding, but I calculated it on labor, opportunity cost, depreciation, and inflation. So I had all four of those things in my budget. We had a really bad year. We had a big snowstorm come in, the snow got deep, we had freezing rain. It was just a disaster year for swath grazing. And I had to leave a bunch of land, right? We couldn't get to it. The cows, we basically had to quit swath grazing. We had 100 acres left over that we couldn't graze, but I have to still pay for it. In the spring, I had to go out and mow that swath so that the farmer could go out and still manage his field, right? So I had extra costs on top of it. Well, the same thing happened to him. But when he didn't make as much profit as he was hoping, he didn't get paid, right? He did the whole winter and never got paid. When I didn't make as much profit as I thought, the first thing that got sacrificed was, I didn't cover my opportunity cost, right? There was that 10% that I planned for opportunity cost that I didn't cover. Did that hurt me financially? No, right? I still paid myself labor. I didn't make enough profit to cover my depreciation. Right? Well, this year that doesn't hurt me financially. I just didn't cover the depreciation on my equipment. I better make up for it next year. Right? So I didn't cover that. Did I cover inflation? Well, maybe that doesn't hurt my pocketbook. I still got paid. Right? The last thing that I sacrifice is my labor because I've already budgeted, above that. Whereas he just put, he was just budgeting that I make this much in labor. He didn't get paid the whole winter. Right? He did all that work and never even got a wage. So we have to account for those things in advance on our paperwork. So, another question? Yeah.
What's the difference between being really aggressive in marketing versus just selling at a the commodity price kind of thing? Does branching profit kind of teach people to go after that, or because it does take extra management work to get?
Oh, for sure. It goes into your gross margin, right? If you have extra labor in marketing, well, you need to cover that in your profitability, right? If you market like crazy but you don't make enough doing it, you're losing money, right? You shouldn't have marketed because you made more money by doing nothing, right? It just comes to that big number and little number. You've got to account for the labor in your marketing as well. Because if you had to hire someone to do it, but it didn't do you any good, you didn't make any more money because of it, well, then your margin got smaller. But if you market really well and you got more customers because of that and your margin got bigger, well, then it was worthwhile. So it's the same thing. It's just another cost added in there. Was it worthwhile? Yeah. Good to go? Okay, I know it was boring, sorry. But it's really important. I can't emphasize that enough. This was a breakthrough in my business to understand a gross margin analysis. So if anybody wants just a simple Excel spreadsheet to do part of this, just email me. You can find my email anywhere, skenyon@greenerpasturesranching.com. And I'll gladly send it to you for free. So, good to go?